Hi everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be exploring real estate investing versus stock market investing. So if you're an investor and maybe you've been putting money into the stock market or what we sometimes call paper assets, maybe mutual funds or bonds, and maybe somebody's talked to you about, hey, you should invest in real estate. In this video, we're going to kind of explore some of the advantages of each of these and really kind of help you make a decision whether or not real estate is something that you might want to consider adding to your overall portfolio. Now, if you know anything about me, you know that I am a financial advisor and I've been one for about 25 years now. And so our business is really based on helping people build up what we call paper asset portfolios. Portfolios consisting of stocks and bonds and mutual funds and different investments that most people are working towards saving toward their retirement. But we also talk a little bit on the channel here about real estate as an investment. And we also talk a lot about passive investing. And both of these two categories can definitely fit into that passive investment category, but I'm going to show you here why you actually might want to consider real estate as a part of your portfolio. So let's take a jump in and start looking at some of the historical rates of return for each of these two categories. So according to the Case-Shiller Housing Index, since 1928, real estate has averaged about 3.7% over that period of time, and the stock market has averaged about 9.5% over that same period of time since 1928. So first of all, you might say, hey, Bill, don't you know that 9.5% is higher than 3.7%? Why are we even talking about this anymore? It's clear that stocks beat the real estate, so why are we still talking about this? Well, that's what we're going to dive into here is we're going to start looking at some of the advantages that real estate has. And one of those advantages is the leverage that real estate has. So if we think about investments in the stock market, if we want to buy $1,000 worth of stock, we have to have $1,000 to make that purchase. Now, I know some of you will say, hey, Bill, there's margin. We can actually borrow a little bit of that. But again, that's something maybe reserved for professional investors. I don't even do it myself on margin. I think it gets very risky. And even in the best circumstances, you really can't get the same kind of leverage in the stock market that you can get under real estate. But if we think about it and we say a $100,000 housing purchase, and I know that it's very difficult to even find a house valued at $100,000 anymore, depending on the area that you might live into. But if we use that just to keep our math simple, we might be able to buy that $100,000 house, even if we're talking about a 20% down payment, we can buy that for $20,000 out of pocket. So essentially, we're controlling a $100,000 asset with only having to put $20,000 of our own money into it, versus over here, if we had that same $20,000 and we put that into the stock market, we've got to have that $20,000. We don't get $100,000 worth of stock. So now let's jump over to the real estate side. If in fact you're getting a 3.7% average rate of return, in fact, I'm going to actually make my math just a little bit simpler here and actually reduce that a little bit and say we're getting 3.5%. So if in fact the real estate of $100,000 goes up by 3.5%, that means that you actually increase the value of that property by $3,500. So again, that's a 3.5% rate of return, but it's a rate of return on the gross amount of that property. When we look at that 3.5% or that $3,500 as a component of how much money we actually put into it, the $20,000, that actually tells us that we've actually made a 17.5% rate of return off of that initial investment. Again, now we're oversimplifying. There's obviously the down payment here. There might be some mortgage closing costs. There might even be a little bit of rehab and everything. But I'm just trying to oversimplify this a little bit just to say, even if this number was a little bit higher, that still is going to be a very generous number, especially when we compare it to how our money might perform by having that $20,000 investment in the stock market here. And again, there's also going to be a lot of work involved in this real estate too. So you can buy a stock very easily. You can click a couple buttons on your computer, talk to your financial advisor, pick a stock, and there's really not a lot. There's a lot of legwork that goes into real estate investing, and that's something I think I want to mention to you that it is something a little bit more challenging, but it isn't something that you should completely ignore because of those challenges. And open your mind a little bit to the idea that this could be something worthwhile. So when we talk about real estate investing, I say there's usually a couple different ways to make money, and so one of those is the appreciation that house is hopefully going to have. If we're talking about, let's say, a single family house, or even if we're talking about an apartment building, and what is that appreciation relative to that money that we put into it out of our pocket. The second type of income that we're going to make is, I think, one of the most important ones. And as we're starting to talk about passive income, what is the cash flow from that property? And so my rule of thumb, if we're talking about investing in real estate, is you don't want to buy any property that after you've covered your mortgage, your taxes, your insurance, an amount for maintenance, vacancy, kind of all of those costs, if you don't have enough rental income coming in to cover all of that and still have a little bit of positive cash flow, then you shouldn't buy that property. And so when we bought our rental houses, we looked at literally hundreds and hundreds of properties, and some of them we actually went out to visit. Some of them, we just kind of sifted through real estate listings for. And actually, one of the guys that kind of mentored me a little bit on this real estate said that you're going to have to look at 100 properties, or look at 100 properties, maybe find 5 or 10 that you might put offers in on, and then maybe you get lucky to get 1 or 2. And I found those numbers to actually be pretty accurate there. So you want to find that property that's cash flowing. If it doesn't cash flow, you're not going to buy it. So for purpose of this example here, let's say that your cash flow on a monthly basis is $200 a month. Obviously, that would be $2,400 a year. And again, that's the cash flow after all of your expenses, and you want to make sure that you've done your numbers, calculated them properly. We'll have another video where I might take a deeper dive on that and show you how to actually analyze the numbers in a real estate deal. But again, if we say we're getting $2,400 a year and we compare that to our original $20,000 out of pocket, well, that's another 12% return that we're making on our money. The next one is going to be our mortgage paydown. We'll call principal. And what I mean by that is, obviously, if you're borrowing the money, so in this example here, you put down $20,000 and you borrowed $80,000 on a mortgage. Well, who's paying that mortgage? Well, I mean, you're physically paying it, but actually, again, to be able to cash flow, your tenants are actually paying you enough rent for you to pay that mortgage. So that mortgage is being paid down a little bit every single month in a principal reduction. So I did some quick math here, like at a 4.5% interest rate, the amount of principal that's going to be paid down is about $1,290 a year. That's in first year. And actually what happens with real estate, or any mortgage for that matter, is that every year that goes by, because the balance on the mortgage gets a little bit smaller, more of your payment goes towards paying that principal down. So that's going to be the lowest that that's ever going to be in this example here. But again, just to kind of use that might be another 6.5%, I guess, roughly. For your return. So you can see how this is really starting to add up. The next one that we'll talk about are taxes. I'm not going to spend a lot of time on this because taxes for real estate get a little bit tricky. The IRS looks at real estate investment as a passive activity, and so they do have some pretty strict restrictions on how much you can actually deduct, but they do have something called depreciation. And so the way it works is on a residential rental property, they use 27.5 years, and what that means is they're going to let you amortize a depreciation of that property over 27.5 years. And if you qualify for that, it might give you a little bit of extra help on your income tax return. We're not talking a lot of money, probably something well less than $1,000. And if your household income is over $100,000, it starts to phase out where you can't even take that deduction unless you meet the qualifications of what are called a real estate professional. And to do that, you have to spend a substantial amount of your time, and it has to be a substantial source of your ongoing income. They do open that up and become a little bit more generous with that. So some people might get that, but most people probably won't be able to take that deduction. And the last one is what I call forced appreciation. And that's kind of the nice thing about the real estate market compared to the stock market. So if we want to buy Netflix stock, there are literally thousands of people at any given moment all bidding on Netflix, all kind of trying to digest all of the relevant information, how many new subscribers they're getting, what new programming they have coming out. And so you're not going to get a deal on it. It's going to be, the price is the price. But on a real estate transaction, because housing is going to be different, neighborhoods are different, the amount of buyers is going to be substantially reduced. So it is possible that you could go back and you could buy a house that theoretically could be worth $100,000 and buy that for something less than $100,000. So let me give you an example of this and how this sometimes works. We're going to change our numbers up a little bit, but let's say you buy that house for $100,000, but it needs some work. and maybe it needs just some cosmetic things. Maybe it needs some paint and carpet. Maybe the furnace is old, and because of some of these cosmetic things, the house is not really getting a lot of attention. And so you come along and you kind of see a vision for this house and say, hey, this is something that's pretty good, and fixed up, that house is really worth $150,000. And so you say, hey, I'm going to buy that house, and maybe I've got to put $20,000 into it to kind of get it equivalent to what those other houses are. But you can see right there that if I buy a house for $100,000, put $20,000 worth of work, and now it's worth $150,000, there's $30,000 worth of what we call forced appreciation, where you're putting some value into it and getting a benefit from that. Now, you can't go pull that money out, but eventually when you sell the property, that's going to be one of the factors that's going to lead to that total rate of return. So again, going back to this and saying, hey, I'm going to have that appreciate a little bit, hopefully every year. Now, keep in mind, just like the stock market, we don't get appreciation every year. There are times when, we maybe get less than that 3.7%. Sometimes it might even go negative depending on the area or the economic environment. We all saw that in 2008. Where the housing market pretty much across the nation went down pretty substantially. So it doesn't always happen. But what does happen a lot of times is we do kind of compensate for that from time to time, where if we go through a period where it maybe is going down or a little bit slower, sometimes we have periods where it's growing a little bit faster. And again, that's the same thing that the stock market does. We average 9 or 10% a year, but some years it might be up 30%. Some years it might be down 30% or 40%. And real estate doesn't tend to be quite that volatile, but it does have that year-to-year difference there. So anyway, we're just kind of skimming the surface here on real estate as an investment category. But if you haven't really looked at this before to kind of understand, how that leverage really works, I think you should. And I think it's something that most people should consider, and especially going into that passive income or becoming that financial independence scenario, this is something that can really potentially help you get there a little bit faster. So anyway, hope you enjoyed the video. Again, don't forget to hit that subscribe button, the little notification bell. That way, anytime we're doing a new video, you'll be sure to get notified for that. It really does help our channel out quite a bit. And again, we're going to continue doing more videos like this. Money Evolution is all about financial education, and that's our #1 goal, is to help teach you things that are going to help you make better or more confident decisions regarding some of your finances and the money that you have. So have a great day. I'll see you back in our next video. Thanks.